What's going on, everybody? All is well. So today I want to talk about um, call options, and in this example, I'm on Robinhood and I'm using AMD as an example. All right. So let's get right into it. So up here, you want to buy. You should um, buy is highlighted, and you're buying a call. So call is highlighted. Now the expiration date, obviously, if you were to buy a contract, any contract, and you select the expiration date for tomorrow, obviously it's going to expire tomorrow. Now you could adjust the expiration date as you see fit. You know, if you want to push it out to January 16, 2026. Now you notice the cost of these contracts increase because you're pushing the expiration date out. So basically, you're paying for time. So let's just go back to tomorrow's expiration date. Now let's look at the 170 strike price. So this contract is worth. I know it says is worth 58 cents, but each contract is worth 100 shares. So it's actually 100 shares of AMD per contract. So you got times that by the axe price, So it's saying the contract is 58 cents, but in actuality, times that by 100 is $58 per contract. All right. And this is a share price. Currently, AMD is at 166. Now, another thing I want to touch on is being in the money and out of the money. So, in the money is a. Let's do the 160 strike price. This contract is in the money. Why? Because remember, you're buying a call, and the share price is already past the strike price of 160. Now the share price is 166, so it already blew past the strike price. So you're basically, if you were to buy this 160 contract at $450 per contract, you essentially be already in the money. Now let's go back to the 170 strike price. This contract is $58. This is out of the money because the share price has not yet surpassed the strike price of that contract. All right. And another thing, let's say you got an expiration date, so let's say you push that out to the end of August 29th. If you buy, let's say you buy the 170 contract. You don't have to hold your contract until it expires. You could sell it before the expiration date. Let's say you buy it, the contract today, and next week AMD takes off, and you're in profit. You're up 20, 30, 50%. You could sell it right there and then and lock in your profits. You don't have to wait until the expiration date expires. All right. And oh yeah, a leap option. A leap option is basically a contract that has been pushed out a year or 2 years out. So let's say you buy AMD. You want to buy a call option on AMD, and the expiration date is January 15th, 2027. So that's essentially a leap option. So let's do 170. So now you see the price of the contract increased. So a 170 call option on AMD with expiration date of January 15, 2027, one contract is worth $3,570, because keep in mind, one contract equals 100 shares. All right. So essentially, this is a leap option at this point. And one leap, I'm starting to like leap options because you have time on your side. So let's say you jump in a leap option and that stock goes down, you have time on your side. You have enough to give. You have given yourself enough time, so the contract could recover. Because keep in mind, you're buying a call option. So when that stock drops, so does the value of the contract. So you're giving yourself enough time so your contract could the stock could recover, and so will your contract. Now, when let's say the market pulls back or it crashes, you can jump in a leap option, and then when that particular stock runs back up, so does your value of your contract. So in my opinion, a leap option is one of the safest ways to 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 get into buying calls. Because like I say, you have time on your side, but the only thing is, obviously, it's gonna cost more, and you need to be patient. You need to be patient. So the stock could run up and do its thing. That's why I prefer to jump in the leap on a stock, a quality company that has pulled back significantly, or when the market generally pulls back, or let's say the market crash, like when back in April when they announced the tariffs. You know, like events events like those that crashes the market. In my opinion, is the ideal time to just buy a buy a leap option on a quality company, of course, and you just hold it and just be patient. And it's when it runs up. And that's another thing. Don't be greedy. When you're up, take profits. Lock in profits. Don't be greedy. Like I said, you don't have to wait until the expiration date to sell your contracts. All right. So generally, that's a call option. How to buy a call and leap option. Now that's the easy part. The difficult part is, let's say you're looking to buy a call option on AMD. Ideally, you want to know where the support levels are, where resistance is, so you could get in you could buy the contract when it's at support. So it's gonna bounce off of support, and then it's gonna continue to run up until it finds a resistance level. That's where the real that's the hard part when it comes to buying call options, is the technical analysis of the stock that you're looking to buy a call or a leap option on. That's the hard part. This is just understanding the concept of buying a call. That's easy. Is a technical analysis of that particular company or stock you're looking to trade. That's where the difficult part comes in. That's where you really need to understand the charts and stuff like that. That's where the work comes into play. And another thing. Now, I'm not a day trader, anything like that. I'm still learning how to buy call options, buy puts, you know, understanding risk management. So I'm still learning, you know, I'm still in the process of learning everything. And I'm just, as I learn, I try to implement it, and I learn from my mistakes, and I keep it going, you know. But I say this to say, when it comes to trading options or leap options or puts I say this: you need to understand how to invest long term first. Then you can learn buying buying puts and call options, because the same discipline that you need when it comes to being a long term investor, the same discipline you're gonna need, especially when it comes to um, buying calls or buying put options, because you still need risk management, still need to be disciplined, you still need to buy low, and also you need to understand the stock that you're buying a call or put option on. You need to understand the support and resistance levels are, and stuff like that. So, my opinion, just make sure you get your fundamentals down as a long-term investor, and then absolutely you should learn how to buy calls and put options, because in my opinion is the fastest way to make money in the stock market, but also when not done correctly is the fastest way to lose money in the market as well, you know. But that's where risk management comes into play, and the whole 9 yards. But yeah, that's basically what a call option is in general. A put option is basically the reverse. Let's see. Let's do wait. August is August 29th. All right. So basically, uh, oh yeah, this in the money, out the money. Let's look back at this 170 put option. So the cost of this 170 put option is $1,105. Now keep in mind there's a put option, so the value of this contract is going to be high because the share price is 166. It already um went past the strike price. It already went down past 170. So you basically, there's an in the money put option. Out of the money is this 160 put option, because obviously the share price is at 166. It has not yet passed this 160 strike price. So that meaning this 160 put option is considered out of the money. And yeah, and that's basically it for the most part, you know. Anyways, I hope this video was informative, and until next time, you guys, be safe, stay cool, and enjoy the rest of your day. All right, peace.